Good morning, good afternoon, good evening, everyone. I hope you can hear me. Welcome to this last session, I think, in this series on the PCT tax incentives principles. My name is Christoph Waarzegers. I'm a Deputy Division Chief in the Fiscal Affairs Department of the IMF, and will be moderating this session. Before we start, let me maybe briefly introduce our speakers in this session. In the order of appearance, if I have it right, we will first have Michael Keane, who's a PCT consultant and former Deputy Director in the Fiscal Affairs Department of the IMF, followed by Louisa Dressler, a Senior Economist in the Center for Tax Policy and Administration at the OECD. Then we'll have Olivier Muyaneza from UNDESA. He's Economic Affairs Officer at UNDESA. And then we'll also have Rajiv Kumar he's Senior Economist in the Global Tax Unit at the World Bank. So what do we want to do in this session? Well, we want to introduce to you the PCT's draft tax incentives principles, a consultation draft of which was released late last year. And we will also reflect on how this work relates to what each of our institutions is doing in this area. So we can start with the presentation. So just by way of quick background, many of you might remember, and I do hope you do remember, that in 2015, so now conveniently 10 years ago, the PCT published a report on tax incentives entitled Options for Low-Income Countries, Effective and Efficient Use of Tax Incentives for Investment. In short, we call it the Tax Incentives Toolkit. It actually had two parts to it. There was a report plus a background paper with more technical instruments for assessing impact and cost-benefit analysis, etc., of tax incentives. Now, of course, as you all know, many things have happened since then in the international tax space. And so with the four partners of the PCT, we decided that it was time to revisit this document in light of these developments. Of course, move to a global minimum tax, also other concerns of policymakers, for instance, the green transition, and more generally reflect on to what extent these principles or the underlying principles in that report are still relevant today. So what have we done so far? So if we can go to the next slide, this is just a brief recap. We had a seminar that we hosted in Washington, D.C. at the World Bank with stakeholders to sort of have a broad-ranging consultation on the relevance of this issue, what are the current issues, and how can we best sort of revisit this area in a way that sort of adds to the existing material that's out there, and also I think kind of stands hopefully the tests of time. We then established we call a subgroup with representatives of the four organizations, some of whom you will meet today. In the meantime, and this is already live on our website, there's also what we call a resource tab. So basically, we've collected a lot of materials that we think are particularly relevant to this topic, and that can be just by way of reference for you to look at. Of course, we don't want to duplicate what's out there. So that's also a way of saying, okay, if you want further information, deeper analysis on certain topics, these are some of the materials we think are relevant. It's by no means exhaustive, obviously, but it's also not limited to material that the four partners have produced. It also references other organizations, authors, etc. As I mentioned from the start, we have published a consultation draft, and Mick will take us through that. It was published in December. Consultation period is closed, but obviously we are still working through the comments. So if there's still feedback at this time, we are open, of course, to receive that. So I think with that, because we also want to leave time for questions and comments at the end, I'll pass it on to Mick, who will take us through the draft principles. Mick?
Well, thanks very much, Christoph, and hi, everyone. So what I'm going to do in the next 25 minutes or so is not go through the document in all its detail, but to give you a sense of the highlights of the document and its structure. So just to give a quick overview of the approach and the structure. So there are basically 6 principles that are set out in this draft document, more or less covering the life cycle of incentives. And we'll go through each of these. So we start with justification, then we talk about design, then international considerations, then the legal framework, then implementation, and finally, importantly, evaluation. So we're going to have these 6 headline principles, under each of which there are sub-principles, which I'll show you. I won't go through all of them in detail, but that'll give you a sense of the principles and the sub-principles for the implementation of each of these higher level principles. There are, as in the document, there's also some rather lengthier remarks that expand on various points in the discussion of the sub-principles, and which, as Christoph says, also point to guidance materials where we think that there's more detail than we can provide in this document. That may be useful sort of supplementary resources. A few things to say about the nature of the principles. They are kind of explicitly aspirational. That is, we know that few, if any, countries currently achieve all of the things that we set out as the high-level normative principles. We recognize that countries have all kinds of resource constraints. We kind of don't keep repeating that point for every principle, but it applies across the board. But nonetheless, we hope the principles will help countries make use of however limited resources they have available. To be clear on what we're going to mean by an incentive in this context, so we're going to mean by an incentive a tax provision that offers some preferentially favorable tax treatment to some subset of taxpayers, and moreover, it has the intention of promoting some kind of particular activity. And the activity here can be very broadly defined, can be employment, regional development, social development, in other forms, knowledge transfer, whatever, R&D expenditure. But it wants to promote particular activity. It's not a purely kind of distributional tool. It's trying to incentivize change behavior in some way. And I should say that the general kind of approach to incentives that motivates the document is that, yes, incentives can certainly be useful and serve a helpful purpose. At the same time, however, offering special treatment to particular taxpayers does run particular risks. It runs particular risks of distorting behavior, of other aspects of behavior, foregoing revenue, maybe to little positive effect at the end of the day, so it may be economically in some sense ineffective. And of course, preferential treatment also creates potentially distinct issues of governance, rule setting, and control, and so on. Final point just to note is that we intend the principles to be broadly applicable. So they're rather broader than the discussion in the 2015 PCT document that Christoph mentioned, which was pretty much only corporate tax. Here, we're trying to be rather broader for a whole range of taxes that have this incentive provision defined in the second last bullet on the slide. But nonetheless, it's clear that for now, at least, business taxes are primarily in mind. I think we recognize, the group recognizes that application to other areas may in some cases need a little more thought, a little bit more development. So with that kind of general overview of what we're trying to do, let me launch into, if I may, Adrian, the various principles themselves. So we're going to have 6 slides like this, corresponding to the 6 high-level principles that I mentioned. So each of these slides, what you see at the top in the kind of tastefully colored blue box, is the high-level principle itself. And then in each case, we have these sub-principles, which you will see here. Each sub-principle has a short description that goes with it in the main document. And then, as I say, further elaboration sources are in the remarks, which we're not going to be showing or talking about. So let's start at the kind of beginning of a life of an incentive. Well, why might an incentive be a sensible thing to do? Well, the argument here is that incentives are warranted if you can reasonably expect that they're going to generate some net social benefits. And the reasons that you believe that are clear and publicly articulated. So there's a number of elements here to unpack. First, highlighted really in the sub-principle 1, so rather bureaucratically labeled P1.1, which is highlighting that there must be some kind of social benefit from the incentive. A private benefit in terms of increasing profit, well, that's a distributional policy, which may be good or bad, but it's not an incentive in the sense of trying to induce changes in behavior. Really, if you think we only think there's going to be too little of something that we want, if essentially the private benefit from doing that does not reflect the full social benefit. So there has to be some social benefit in addition to the private benefit from an activity in order for an incentive to be warranted. So we have to be looking beyond private benefit to social benefit. What do we mean by social benefit? This, for the moment, can be a whole range of things. It could be job creation, it could be regional development, it could be developing a particular skill in the workforce, could be all kinds of things. The point is it's not private profit. So there has to be, so we're looking for this social benefit. Of course, next sub-principle is recognizing we need to take account of the social costs. These may be social costs most obviously in terms of potential risks to revenue, but there may also be other risks. It may be that by incentivizing one particular activity, you confer a disadvantage on other activities that you would need to bear in mind to think about what the overall social effect is. So there are going to be social costs too. So what you want to do is you want to compare the two. So do the expected benefits outweigh the expected social benefits outweigh the expected social costs? So the idea is that there should be a clear justification for incentives in this context of an expectation of net social benefits. Ideally, there would be some kind of ex-ante assessment to justify the presumption of an expected gain. Ideally, it would be quantified, but I think one has to recognize that's not always going to be possible. But I think the important point conveyed in the principles is there should be some justification explicitly set out, because then at least you can go back when we come to principle 6 and look back at whether the incentive actually did what it was supposed to do. So you want to say something fairly precise, not just, oh, we want to encourage foreign direct investment. Maybe why do you want to encourage foreign direct investment? Employment, spillovers, better service to the domestic market, what is it? So the idea is that this should be fully articulated, ideally quantified, but at a minimum made explicit and also, of course, made public. A final important qualification here, of course, is that you don't want to use tax incentives if there are better instruments for achieving the same end. Maybe grants are going to be better for some kind of regional schemes, whatever, and maybe regulation is going to be better. But we shouldn't just think in terms of tax incentives. They're often going to be, they may be inferior to other measures. They may perhaps be properly combined with other measures, but we have to think of tax incentives in this broader context. If we come to the second set of principles, which are to do with design, what we want to do here is we want to make sure that we promote whatever it is we want to promote without doing unnecessary collateral damage in terms of distorting other things, and at the same time limiting the revenue cost. So basically you want to maximize what's sometimes called the bang for buck. That is the beneficial outcome that you get per dollar of revenue that you likely forego. So how do you do that? Well, this is what the sub-principles elaborate on. You want to focus on precisely what it is you want to encourage. You want to kind of home in on if it's a particular kind of research and development you want to encourage, focus on that, not R&D in general. At the same time, of course, you want to target finely, but you want to avoid too much complexity. One of the many trade-offs in the area. The second principle is that will sometimes, or quite often, that may argue against using profit-based incentives, that is simple reduced rates or holidays, and instead using things that are directly targeted to what it is you want to encourage, to R&D expenditure, to employment of particular types, whatever it is. Now, that's not to say that profit-based incentives can never have an effect. Clearly, they may well have an effect on cross-border investments, but typically, you have to be concerned that profit-based incentives can essentially confer a private benefit without inducing the change in behavior that is the whole point of the incentive. Often unwelcome side effects one has to think about. And the last principle here, which should be, I've got my numbering slightly wrong here, you want to take measures to limit your exposure to revenue loss, for example, by using sunset provisions. That is a date at which the incentive will expire, unless after review, it is extended, maybe in revised form. This cautions also against the use of fiscal stability agreements that can, again, end up creating an exposure to revenue loss without commensurate benefit in terms of encouraging private activity. Let's move on to the international side of things, because we know that incentives are often, almost always now, conducted in an active, complex international environment. Whether or not they're explicitly intended to attract, or effectively intended to attract FDI, the international context matters. And essentially, a number of points that the principles tend to want to highlight here. One is, of course, countries have entered international commitments of various kinds, and to promote tax certainty and the credibility of the government. Clearly, international commitments, often in a hard law form, are important things for countries to take seriously in terms of commitment and implementation. When we think about incentives design, we have to think also about tax rules and strategic responses elsewhere. So tax rules here, of course, importantly include Pillar 2, global minimum tax, globe rules, which the document provides various links to resource materials on addressing that. But the important point, of course, as I'm sure many people know, is that on the global minimum tax, the effects of incentives may be largely undone where some form of Pillar 2 is going to kick in. Most obviously the IIR. Even when the kind of mechanical rules of that kind don't impact the effective incentives, there may be strategic responses elsewhere, as we know all too well. When one country adopts a tax measure of some kind, other countries may follow suit, may retaliate, whatever it is. So one has to think too about how other countries will respond. Of course, once we recognize this interaction between countries, we know that there can be opportunities for cooperation to alleviate potentially adverse effects, most commonly, of course, put under the heading of international tax competition. So the problem that arises when each country ignores the effect on others of its own tax incentive measures, other countries may respond with their own tax incentive measures, and at the end of the day, revenue is lost. Everybody ends up worse off than they would be if they cooperate. So the principle is that countries should at least be open to cooperative opportunities that may prove ultimately beneficial. And more generally, they may want to take account of how their incentive policies affect others. Let's move on then to legislation. So incentives, because they provide special treatment to particular groups, we obviously need to be particularly careful in addressing the risks to transparency and accountability that can otherwise arise. Excuse me. So the general high principle is incentive legislation should be clear, integrated in tax law, and there should be effective oversight. What does all that mean? Well, it means an important role for the Ministry of Finance, the guardian of public revenues, in no doubt cooperation with other, perhaps more specialized agencies, investment promotion agency, but a clear and pivotal role should be played by the Ministry of Finance in the process of implementing tax incentives, or the process of placing tax incentives into the law. Clearly, we want to make the legislation clear as far as possible, minimize discretion, have robust safeguard procedures, so governance safeguards. So we want to make sure, for example, that we don't have vague definitions of kind of unenforceable, unverifiable conditions, ones that are hard to enforce, hard to verify. For example, what the intended use of some item is. We want to make sure that definitions are clear and there's limited scope for discretion, ease of implementation. Clearly, we want incentives to be ratified by the lawmaking body or parliament, having incentive set out in secondary legislation, only in secondary legislation, runs risks of essentially losing track of what's going on in coherence with primary tax legislation. And we want to, the suggestion is that all incentives should be integrated, consolidated into the tax law. They shouldn't be scattered around in kind of sectoral laws. They have to be included within and consistent with the main body of tax law. That doesn't mean there might not be cross-references to sectoral legislation, for example, of key definitions, but at the end of the day, incentives should be a coherent and integral part of the wider tax legislation framework. If we move on, I can go, I think, to implementation. So at the implementation stage, there is perhaps a sense that revenue administrations sometimes don't spend or put as much effort into the monitoring of incentives as they do to other measures that may be more obviously a risk to revenue. They may be more concerned to raise revenue than to minimize the kind of potential losses that may come through incentives. They may have problems from not having been so closely involved in the development of the incentive as they should have been. So tax incentives, the principle states, we want to ensure that they're implemented in a way that promotes voluntary compliance, limits the risks to revenue and governance, and not least that we end up with the data that we want to have in order to evaluate the incentives at the end of the day. So several sub-principles kick in here. One is that we want, is the overarching principle that it really should be the revenue administration that's ultimately in control of the implementation of incentives of various kinds. For that, beyond the resource issue that I've already mentioned, it needs to have appropriate powers to collect information, if need be to enter premises, all these kind of things to control movements of goods. It needs to have essentially the appropriate powers to enable the implementation of the incentive, technological and others. Again, of course, subject to kind of appropriate safeguards. The second sub-principle is emphasizing that basic compliance obligations should continue to apply. That is, taxpayers should be registered. They should have gone through all appropriate pre-registration checks. And importantly, they should be subject to standard requirements of filing in a timely and full fashion. And that applies importantly, even when there may be some, for example, a tax holiday. We know that in a number of cases, there are problems of tax holiday companies either not being required to file or not really taking their filing seriously, which creates risks both of control and not least for the evaluation when it comes to that stage, which I'll come on to next. So imports benefiting from reliefs should come in with appropriate authorization. All these kind of things, just the basic compliance obligations should be there. Beyond that, of course, we want to support voluntary compliance, which is the kind of the standard approaches of tax administrations, but tailored to the particular circumstances of tax administrations. This means, for example, focusing audit on the high risk cases, developing tailored service facilities for different types of taxpayers, and of course, providing appropriate enforcement strategies. And I think it's recognized too in all this that while we say that the revenue authority needs to be ultimately in charge, there may, of course, be an important role for involvement of other agencies, sectoral agencies, investment promoting agency. They may be important in helping to monitor aspects of compliance or impact. So rules and institutional arrangements need to be in place to embrace the full range of agencies that may need to be involved. That means essentially we want to also to provide all the data that is going to be needed, not only for implementation and monitoring, but also for the assessment and the evaluation stage. And that may require, to some degree, possibly even formal arrangements between the different agencies. So, you know, if you have an incentive that's desired to cut emissions, you have to have some way of monitoring what's actually happened to emissions. And that may not be something that the revenue administration has a particular comparative advantage in doing. So a kind of a broad-based approach to the implementation side. If we come on then to the final stage, which is the evaluation or assessment stage. And so this is, I think, an important stage, perhaps requires more emphasis and even more support and thought than it has commonly required. And this is the point that ultimately you've introduced this incentive because you thought there was going to be some net social benefit. And ideally, you've said what form that social benefit should take. So ideally, what you want to do is at some point that you've specified in advance, maybe with these sunset provisions, you want to ask, well, has this incentive actually achieved what is set out to do? And if it hasn't, maybe you want to get rid of the incentive. Maybe you want to reform it in various ways, but you want to take a look at what the actual impact has been. And this is the kind of evaluation stage, which, as we say, needs to be periodic, so that we know it's going to, everybody knows when it's going to come. Of course, you want to give the incentive a kind of a decent time to achieve what you hope it's going to achieve. You want it to be public for obvious reasons of transparency. And you want it to be evidence-based. That is, you want to actually take seriously what you said at the start as to what the net social benefits are going to be. So several elements of that, of this evaluation/assessment process. So one, of course, is related to tax expenditures. Basically, essentially computing how much revenue have you forgone on the assumption that the incentive hasn't actually changed behavior. That as we assume that there's no change in behavior, how much have we forgone in terms of revenue? So that's what we mean by a tax expenditure. And clearly, this is an important input into any evaluation of an incentive. So these estimates should be conducted and published regularly. That's, I think, probably increasingly the case, but still not the case in many countries where you would expect that it really could and should be. What should be in the tax expenditure reports? Well, they should, beyond the kind of the revenue calculation, it should set out the legislative basis, how the calculation was conducted, ideally maybe what kind of confidence there is in the estimate. But it's also important to include some information on the beneficiaries, at least the kind of the distribution of beneficiaries. That is, what were the top 10 companies, what share of the benefits did they receive, the overall pattern of beneficiaries. In terms of publication of who these beneficiaries are, of course, the standard should be at least as good as that expected on the spending side, because of course the point here is that the tax expenditure is kind of analogous to an item of public spending, so the transparency should be at least as great. Of course, the tax expenditure is not actually enough to do the evaluation. It's based on this assumption that the incentive had no impact. It doesn't tell you anything about the social benefits. So while tax expenditure reports get a lot of emphasis, they're only kind of one part of what a proper evaluation would include. So when we think about these evaluations, which as P6.3 says, we should have a program for these periodic, credible public evaluations. But these evaluations should be referring back to the objectives, the hopes that were expressed at the launch of the incentive. Has it achieved its objectives? At what cost? What has the bang for buck actually been? I don't think anyone underestimates the difficulty of that. We know that's not going to be an easy task. Clearly, it's going to be important to at least say something about what you think the behavioral effect has been, because the whole point of the incentive has been to change behavior. So one needs to think of some way of evaluating what that change of behavior has been. There are some maybe simple metrics that can be used to do that. We talk a little bit about that and provide a couple of references in the remarks, but I think this is recognized as an area where there is more work to do in providing simple ways of evaluating the effect of tax incentives. And of course, we're not saying every tax incentive should have a huge kind of massive study. You obviously want to target this on what seem to be likely to be most important ones. So we finish up on the principles themselves with this important evaluation stage, which in a way then feeds into the reform, review, or ending, termination of the incentives. So again, just to make the point, this is a difficult stage, but worse than the costs of not doing it are extremely large, because essentially you're going to end up with incentives that interested parties will clearly want to put together a persuasive argument that this incentive should continue, but one has to have some safeguard against incentives not being questioned and just rolling on forever. So those are the 6 principles and the sub-principles. So before I hand over to Louisa, just a kind of quick remark on the consultation process in the next slide. So as Christoph said, we've had this consultation with 30 more than 30 submissions. Although the deadline formally passed for submissions, we're still, I think, very much in the market for comments and interested, look forward to the discussion later. At the end of these slides, you'll find an email address for the PCT Secretariat where you can send comments. Easy enough to find that online. But I won't linger on this, but just to note that we organize the consultation in terms of seeking answers to these various questions. So it's kind of very helpful to us. Say whatever you want, but it's very helpful to us to address these specific questions. So with that rather rushed account of the principles and sub-principles, I hope that at least gives you a sense of what's in the document, where we stand. Let me hand over to Louisa. Thank you.
Thank you, Mick. Thank you for this very useful and not rushed, I found, summary of the principles. So as Christoph said, I'm Luisa Dressler, Senior Economist in the Tax Policy and Statistics Division at the OECD Center for Tax Policy and Administration. And I just want to highlight briefly how useful these draft principles are or will be across our work streams and for the relevant stakeholders, I think, as well. And also to highlight that we appreciate the collaboration within PCT with our partner organizations, IMF, World Bank, UN, and the support of the PCT colleagues and Mick, of course, to bring this really useful principles together, we think. So just very briefly to highlight the recent OECD work where we either reflect on the principles already or where there's an interaction with the principles. So we have our OECD Investment Tax Incentives database, where we look at across 70 economies, developing and emerging, and where we look at the design, targeting, and governance of CIT incentives. We had a 2022 update that was published in 2022. And next week, we're going to publish the summary findings from the 2024 update. So how is this linked to the tax incentive principles? It's nice to have these principles to then see how these countries and economies actually apply the principles in our data. And then to also now we have a time series to see whether there have been changes that can be linked to these principles. So that's quite nice to have the principles lined out. Also, we're working currently on a practical guide on tax incentive policymaking, where we provide practical and actionable advice how to better design and implement tax incentives at each step of the incentive lifecycle. And I think that's the document that's most complementary with the principles, because in a sense, what we do is to go away from the principles, but use the principles as the baseline and actually see how countries practically, actionably can actually make these principles come to life. Especially, and Mick highlighted this as well, when countries have resource or policy constraints. You may all be aware of our extensive work on R&D incentives, where colleagues provide indicators and design information on R&D tax incentives in OECD and partner economies. And there again, it's very nice to have the principles outlined in the document to see how R&D incentives align with the principles and what changes policymakers could consider. Then we have a recent work stream on CIT and climate change. We have two forthcoming working papers. One is also going to be published next week, where we start conceptually to examine the main channels through which we see CIT can affect clean investment. But then in another paper as well, we look more into the details of the tax incentives, clean tax incentives, we call them, and to provide an evaluation framework. And here again, it's very important to have the principles lined out, because then we can really ask, how do these principles carry over to policy choices in the net zero transition, in the green transition? And then finally, the principles are very, very useful for our country and regional work, our reports, but also our capacity development workshops, our bilateral assistance. And I guess that spans across the partner organizations, where we really now have a document to refer to and that we can build on when we talk to countries and to officials in the different countries. So very useful from our side for our work are these principles, and thanks for the good work and the good collaboration. And with that, I think I pass on to Olivier. Thanks.
Thank you, Luisa, and thank you, Mick, for this clear presentation, and I do not have much to add to that. Only to let you know that, yeah, first, let me introduce myself. My name is Olivier Munyaneza, and I'm Economic Affairs Officer at the Financing for Sustainable Development Office at the UN Department of Economic and Social Affairs. So briefly, commenting on following up on what has been already said, I would inform you that the UN has worked on a few publications concerning tax incentives. The latest are the taxation of extractive industry, and the protecting tax base, and also on carbon taxation. Both publications are on our website. The extractive industry taxation has been published since the 2021, and protecting and carbon taxation 2021, and protecting the tax base was issued in 2017. In all those publications, there are many aspects of tax incentives, and the work the UN does is basing its normative work. It carries out many capacity building activities, especially in the form of workshops, and tax incentives is one of the key topics we interact with with our participants and beneficiaries. Without really repeating what has already been said, let me just comment or just highlight a few key topics which we come about during our activities, during our workshops. One is on international commitment. It's very important to to liaise or to take into account international commitment when you talk of tax incentives, especially in the area of stability clause, and in the area of Pillar 2, the OECD and inclusive framework Pillar 2 on global minimum tax, and also on the windfall tax. Let me insist on windfall tax because in some aspect, taxation or incentives may be granted on the basis of high costs in investing in some areas, and based on a long-term price, say on extracted minerals. In some circumstances, you may end up with a very high price on that mineral, which would in fact lead to some windfall profit. So how then the contract would be constructed such that in that circumstances, the countries would also benefit from that windfall profit or windfall or high price of minerals. This is one of the issues we insist on. Others concern, the regular assessment to be able to see if the objectives and the goals of tax incentives are being achieved. If not, how to redirect tax incentives, or how to reshape it. And if in some instances the goals have already been achieved, then there is no purpose or no need to continue tax incentives. I think Mick mentioned that very well, that there has to be some type of sunset on tax incentives. Another issue is on doing everything to be able to quantify the benefit of the tax incentives which has been granted. Did it achieve its objective? Maybe should we use some type of proxy to be able to quantify that? I think this is very important. And the other aspect we insist on is on making sure that there is transparency and there is publication of contracts, especially in the mineral extraction and oil and gas, because those are huge contracts, and there is really no purpose of keeping those contracts confidential when it involves public money or public benefits or public exploitation of public lands. Another issue is to avoid discretionary granting tax incentives, and make sure that it's public, and it's even better when it involves more than one institution, a national institution, when it is a consultation among all involved administrative unities or administrative national institution. So briefly, this is what I would say, and this is some of the key aspects we insist on when we are interacting with our participants in workshops and other capacity building activities. Thank you, and probably I think it's over to World Bank. Thank you.
Thank you, Olivier. And hi, everyone. My name is Rajiv Kumar, Senior Economist, Global Tax Unit in the World Bank. And I'll be talking about how the tax incentive principles can be integrated into the country support that the bank provides. So in our experience, many economies have already adopted these principles to varying degrees. Nonetheless, significant efforts are still required to improve adoption rates. Inadequate reporting and evaluation by emerging market and developing economies with high tax expenditures often hinder reforms to eliminate ineffective incentives, broaden the tax base, and lower the tax rates. There are significant gaps in data quality and capacity to measure fiscal costs and evaluate impacts. And so our support aims to address these gaps through 3 pillars, as you can see on the slide: diagnostic support, which aims to identify the gaps and to recommend reforms; capacity building to strengthen knowledge and skills of tax officials, primarily in the Ministry of Finance; and knowledge building to create public goods such as models and manuals for policy analysis. So we brought out a tax expenditure manual last year, which aims to provide guidance to policy practitioners on comprehensively on the important aspects of tax incentives. So our support helps countries identify tax expenditure reforms that enhance revenues, efficiency, equity, and capacity. And we often facilitate such reforms through development policy lending or core diagnostics such as public finance reviews. And tax incentive principles will serve as a useful reference to identify gaps and to help countries pursue necessary reforms. To share a few examples, in some countries, we are supporting the Ministry of Finance to adopt a reform that mandates sunset provisions and conduct ex ante and ex post evaluation of incentives. And here, PCD principles, particularly those that talk about ex ante assessment, sunset provisions, and evaluation, become relevant. Similarly, in some countries, we are supporting reforms that eliminate use of lower rank instruments like executive orders to grant tax incentives. And here the principle that emphasizes that incentives should be ratified by the lawmaking body or parliament becomes very relevant. We are also supporting countries that are reporting tax expenditures for the first time. And here, PCD principles that emphasize reporting and including information related to beneficiaries provide a useful reference. So to conclude, tax incentive principles are extremely relevant to the ongoing and future tax incentive reforms that are pursued by emerging market and developing economies. I'll stop there. Thanks.
Many thanks, Rajiv. I think it's back to me for our last sort of formal formal slide of the presentation, just to conclude this part, to give you a quick overview of what's next. So obviously we will be finalizing the draft based on the comments received. There was a question in the Q&A about this, so we will publish all the comments received on the website. Then tentatively, we intend to have a launch event at some point towards the middle of the year. We're thinking about potentially using the opportunity of FFD4. This is perhaps in the nature of the principles themselves aspirational. We'll see whether this will be the right opportunity or not, but somewhere towards the middle of the year, we hope to have a formal launch event. And then, of course, there's certain areas in which we want to do some follow-up work. This was partly also the purpose of the consultation, to receive some feedback on this as well, as to what further areas we can cover in this topic. But certainly one of the ones that we're thinking of is the last principle that Mick emphasized on evaluation, where or impact assessment, where we think there is more guidance that we can provide, in particular around perhaps more simplified tools for doing impact assessment, cost benefit analysis, etc. As I recalled from the start, we do have the background paper of 2015. There is a lot of material there, but maybe we can do something with that in terms of providing more simplified tools for countries, in particular those with very limited capacity. So I will stop there in terms of the presentation, open up for questions and comments. I see there's one in the chat, in the Q&A, which I would perhaps like to ask Mick to comment on, if that's all right. So the question is, I'll read it out to the audience. The question is from Christian. Shouldn't the life cycle include a stage where the lessons learned and recommendations derived from evaluations are being fed into tax expenditure reforms? Mick?
Yeah, thanks, Christoph, and thanks for the question. Yes, I mean, I think that's an issue that the group has sort of struggled a little bit with, and I think it's certainly something we're kind of thinking about. You obviously want something that is more than, sort of go and start again. So I think that's certainly something we'll think about. I mean, I think it's more than just feeding into the tax expenditure analysis. I mean, there's a whole process around reform that one could discuss, but I would be curious to know what people think the principles should be that in some sense are not already kind of in one way or another covered. I mean, I tend to agree that it should be rather more explicit, but we also want to make sure that there's a sort of clear and something substantively new in all the principles. But as I say, I think that's something the group struggled with in the past, and I think it's certainly on the list of things that has been discussed or is being discussed in response to the various comments received. But beyond that, I think I'd leave it there. Thank you.
Thank you. Thank you, Mick. I don't know if anyone else of our presenters wants to comment on this, but if not, let's see if there are any other questions that have come in the meantime. I don't see any right now, but maybe I'm not seeing it right. Okay. Mick, while we have you there on the spot, can I ask you a question perhaps on that last point I made about next steps and this idea of doing some further work on practical tools? I think you also mentioned it in your overview on the last principle. Can you maybe provide some more background to this, maybe some thinking? I mean, I know early days perhaps, but maybe that can trigger some reaction from the audience.
Yeah, thanks. I mean, maybe I was just just thinking, there were questions about the guidance material that's available, which, you know, as was said, you know, the remarks provide, we hope, a sort of a fairly comprehensive list of things that are available. There's a lot, for example, on tax expenditure analysis now. I think there's a lot of guidance material on that. Very good, very high quality. The area where, to me, it's, and there is also, people might want to look back, in fact, at the PCT paper in 2015, which included a background paper that also has some quite good background material that maybe we need to kind of give some prominence, or the group might want to give some prominence to, again, on kind of thinking about effective tax rates and how those might impact behavior, how to quantify those effects, and quite a lot actually on legal structures. So there is a lot of detail there. But I think, as you say, the area where it's very hard is evaluation. Is evaluation when, particularly when your information is very limited. I mean, it's kind of, you know, the problem is, I think, not only an intellectual one of figuring out, probably at least an intellectual one of figuring out how you would do it, but actually having the data. So actually knowing simple things about, you know, what was the take up of this incentive, how much investment was associated, what were with these incentives. It's not always easy to find in many countries, just the basic data. And I think a lot of that goes back to the ex ante stage of setting out the incentive, to say, well, what are the, you know, what are we trying to do with this incentive? And then when you set out what you're trying to do, think about, you're going to have to collect the data on these things. So I think it's largely, and I think, as you say, I think we need to think more about it, but it's not, in a way, it's not necessarily so much an intellectual problem, but it's making sure that one's been clear about what the purpose is, and has at least tried to collect some basic data on, you know, you might want to think, well, how much of, if you're looking at a regional scheme, you might want to say, well, how much has employment gone up in this region? But then bear in mind, you also want to be able to compare that with what happened with other regions. So you need to collect similar data in other regions. So I think there's also a kind of design issue. When you start off with an incentive, what are the objectives? Let's be clear about those. What are the kind of sort of proxy measures we can try to at least get some handle on the extent to which that has happened, and then take it from there. So I think, you know, as I say, it's not necessarily a huge intellectual problem. I think it's largely kind of a data and clarity of purpose and thoughtfulness in collecting data. So I don't know. That's my kind of initial thought. But I know others in the PCT group have also thought about these issues. So they may have thoughts too.
Thank you, Mick. See if maybe Rajiv would like to come in from his experience working with countries on this. If not, we have another question that we can go to. Rajiv, any follow-up thoughts from you on this?
Yeah, so just to add what Mick said, you know, this is an extremely difficult area for a lot of emerging market and developing economies, because you know, first of all, data environment is generally very weak. So many times, even when you know, there is a vague purpose that the policymakers have in mind around an incentive, because there's no data available, a quantitative sort of evaluation becomes very challenging. And then if the data is available, then the next set of challenge relates to the technical capacity itself. Now, there are approaches out there which can be used to evaluate certain kind of incentives if they satisfy certain conditions, but they may not always be applicable. So there are methodological challenges as well, and which is why we see that empirically very few countries evaluate their tax incentives. And if I can quote the analysis done by the Global Tax Expenditure Database, it's only 16 odd countries which have actually referred to evaluation in the tax expenditure reports. So an area which requires more work and more capacity building, I would say, and We are, in fact, in the process of developing a technical guidance for countries to evaluate tax incentives, and hopefully we can shed some more light and then provide more support in this area.
Thank you, Rajiv. Much appreciated. We received another question, which I will translate in English for the audience. It's specifically on stability clauses, and the question is there a ideal time limit for such clauses, or what are some of the criteria to take into account for limiting or constraining such clauses? So I pose this perhaps to Olivier, I think, who mentioned this. Maybe is there some guidance from the UN, perhaps, in the work on extractives, where I think there was certainly discussion around this complex issue. Olivier?
Thank you, Christophe. You want me to answer in English or in French?
I think let's do it in English. I think there is translation available, interpretation available for those speaking different languages. Thanks.
Actually, what I would say is that the stability clause is, I'm going to roughly define it as being a clause in which the country and the investor agree that there should not be any new policy or any new legislation which will impede or which will decrease the expected profit of the company investing anywhere, say, in a particular sector, so that the stability issue at stake, it's being able to have a stable an estimate or an expected profit or outcome out of their investment. So if there is, say, a change in just as an example, in a VAT rate, then it becomes very hard for the company which will see its profit being reduced by the same amount or more or less. So that's the stability clause. However, the issue is that if the company is projecting or making its investment based on a particular price at the international market, the long-term price, then of course the price would fluctuate. If the fluctuates going up, there should be some justification to review that stability clause. What I can give as just a quick example is, for example, in the recent, I think, contract Uganda had with its investor in its oil field, there was a price set beyond which then the tax incentives will no longer apply. If, say, I do not have the amount or the rate, but if, say, the price is more than, say, $100 per barrel, then if it's more than $100 per barrel, then there is no longer need for tax incentives, because the long-term price was set at $100 per barrel. So in practical term, there is no particular limitation. It has to be on case-by-case basis, and also take into account, for example, some of international issues. For example, when you talk about the minimum or the global minimum tax, for example, if, say, you as a company, your projected benefit was at a certain level, only to see that benefit being taxed somewhere else, in fact, your revenue would be reduced by the same amount. So it's not that the country in which you are investing is changing the stability clause and is taxing more, because your revenue would be the same, because what is not taxed at the country level, at the source level, will be taxed somewhere else. So that's, for example, one of the issues the stability clause should not apply. Thank you. More or less that's how I would summarize the issue.
Many thanks, Olivier. Complex area, obviously. We're kind of coming to the end, I think, of this session. I'll just pick up on one more question that was asked in the Q&A in English, in Spanish. Obviously, my Spanish is not as good as Google's, but the question effectively asks whether what help can we provide to Mexico in relation to its evaluation of tax incentives. So I can relatively easily deal with this question by saying, well, this is not particularly a role for the PCT as such to play. So the role of the PCT is to provide this kind of guidance to I'd say the taxpayer public or the tax administration or tax policy making public more broadly, but for in-country assistance. Of course, you are most welcome to reach out to any one of our 4 partners, or all of them individually, with this question. As was clear, I think, hopefully from the presentation, we all work in this area. And so there's always potential assistance that you can receive from each one of us. So with that, I think we can close the session. And thank you very much for bearing with us, for joining us and engaging with this topic. If, as Mick pointed out, there is still an email address on our website, if there are still comments or feedback that you would like to send in relation to these draft principles, please do so, but don't wait too long, because we do want to finalize the document in the coming weeks. So with that, thank you so much for joining. Thanks for the presenters for making the time, and have a great rest of the day or evening wherever you are. Thank you so much. Goodbye.